Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we will discuss Donald Trump's tax return, and it's really a case study for divorce attorneys and what to look at in a personal tax return with Jason Soman. He's a valuation expert in Boca Raton, Florida. He owns his own firm, Accounting and Valuation LLC, and he's specializing in business valuation and forensic accounting in the context of divorce. Welcome, Jason. How are
Thank you,
you?
Melissa, for having me. It's a pleasure to be back on.
But tell us, what else we should have known or to look for.
Absolutely. So, we kind of hit on this earlier when we were talking about Schedule B, but, Schedule B is only going to really report interest income, right? So that's going to be like we spoke about Mar-a-Lago Club before, right? So that showed the interest income received from Mar-a-Lago Club. But in Schedule E, now we're talking about what's the business income received from Mar-a-Lago Club, right? So Mar-a-Lago Club, let's assume that it's the Mar-a-Lago that we're all thinking about. That's a country club, right? So they're probably making very little income in terms of interest because they're not a bank or they don't own debt. So, you may see items that aren't on Schedule B because they don't report income, but they're on Schedule E because they're business income. So Schedule E is going to report all the business income, and just like the interest, it's not cash received, it's business income allocated to a partner for tax purposes. And just like Schedule B, we have to get all the K1s to really understand what cash was actually received. And if we really want to understand the nature of the business, its income, and its expenses, we're going to need tax returns, financials, general ledgers. I think on every single one of these companies that we see here, if we're going to go the full distance and value everything in this marital estate, we're going to have to prepare valuations for all of these companies. These may be companies where he's a passive owner and he owns 1%. Some of these companies may be things that he owns 100%, right? So, it's going to come in. What also comes into play a lot in divorce situations is like, okay, well, I could assume I could get anything from Trump Plaza LLC because like he probably controls it, right? But if I look at 57 line AF, 57 Management Corp, he may be a 1% interest owner in that company, and he may only get a K1 every year. So, something that also to think about is, well, can they get the documents that you would want? Do they have access to them? Can they control these things? And, I think Schedule E is important. I mean, we covered a lot of the main concepts in terms of cash flow, income, and the K1s and whatnot. But you're going to mostly see, I think, business interests that people own in Schedule E. And if you see it on a tax return, you're going to want to put it on your radar. And partly because I think it's important for everyone to realize, right? Like, you're not going to find assets on a tax return if they weren't reported, right? So, it's also like you want to develop this list using the tax returns, because then if you see another entity, right, and you don't have it on your list, you're gonna be like, well, why wasn't that reported on the tax return? You'll start saying, that's why, and I've stressed it throughout this podcast, is it's all about building that universe. A lot of what we do as forensic accountants is we cross-reference things, right? So tax returns are a great starting point. We have a list of 200 companies that the Trumps own. That's like our hub. And then any other information that comes our way, we're checking it to our hub, right? So
Yeah.
we're consistently looking and building and packing that snowball until we fully understand all these companies, the nature of their assets, what they're worth, what the cash flow being generated from them is. And, I think that's why, and I hope that people throughout this podcast that are listening realize the importance of the personal tax return. It's not the end all be all. A lot of times it creates more questions than answers, but it's a damn good place to start, in my opinion. And it's really one of the first places that I start on every single divorce case.